Hello, welcome to 2025. I hope you had an awesome 2024 and you're going to have a prosperous 2025. I want to thank you for joining me today to talk about where we ended 2024, where we're going in 2025, and what you need to be thinking about or focused on right now. So let me share my slides and let's talk about what 2024 looked like here in the US and around the globe. The S&P 500 was up nearly as much as last year. We ended up 23.3%. The NASDAQ was up 28.6%, still more than the S&P 500, but that was 2/3 of the gain last year. The mid-cap 400, the small-cap 600, those were still up for the year, but not nearly as much as the large caps. And we see that the mid-cap 400 was up 12.3%, and the small cap 600 was up 6.4%. Around the globe, the all country index is up 15.5% for 2024. But if we take the US out of that, the all country index, excluding the US, was up 2.2%. So the rest of the globe did not do as well on average as the United States. Europe was actually down 1.9%. Japan was just at 4.6%. A lot less than they had in 2023. And emerging markets were at 4%, less than 2023, but not as big of a difference. So that was where we ended 2024. The US had a very strong market and stronger than the rest of the globe. Now we have no sign of slowing down as we're heading into 2025. And we've got a lot of spending here in the US, much more than around the rest of the world, in AI related areas. Corporations are putting money into things like data centers, technology. We need a lot more energy. There's a lot of areas where spending is happening now and is going to continue to happen as we build out the new tech, the new AI, all of the things that we're looking at. That's going to be very positive for the growth in the US as those things come to be. And so we want to pay attention to those areas that are going to benefit from this new technology or this improved and increased technology. Now, we also have a new government coming in. We're going to have a Republican president, a Republican Senate, and a Republican House. And because of that, we're very likely going to have some policy changes that get enacted early in 2025. That's going to be a lot easier with that Republican trifecta. And those policy changes could lead to us having higher rates for longer. We'll talk about that in a minute. But in 2024, rates were key, and they're going to be key again this year. And we want to watch where rates are going. Are they going up? Are they going down? What is the Fed doing? In 2024, we saw that large caps beat small caps and the rest of the world. But that's only true for the, say, 75% of the year where rates were not coming down. There was a period of time where rates were coming down. And during that period of time, small caps and the rest of the world actually beat the US large caps. So that is something to watch this year because rates could continue to come down. I don't expect them to come down as much as the market is thinking, but I do think they will come down some. And so we want to watch this area. Now, those policy impacts that I mentioned, there's three key policy areas that could have some impact on our inflation, our GDP, and thus on rates. First is higher tariffs. If we get higher tariffs, as it looks like we will, that is inflationary. Our importers would have to pay more to import, maybe not be able to import, maybe have to recreate sources of developing their goods here within the US or in other places. Our exporters would not be able to export or would have to have a smaller profit on some of those exports, as possibly there are some tariffs on the other side of the trade. And then our consumers would end up paying more because whatever happens at the company level is going to trickle down to the consumer who is paying for those goods. Otherwise, the company is not going to stay in business. They're not likely to reduce their profits significantly. They still need to pay for their employees and all the different expenses that they have. So that becomes inflationary to the consumer. It also reduces GDP. If the consumer has less money to spend because they're paying more for the goods and services, that's going to be inflationary. Same with companies, same, as some of these tariffs flow through and they're having to spend more for some of the goods, they're having to spend less on some other areas. So that reduces our GDP potentially. Number 2 is lower taxes. And lower taxes would actually be a boost to GDP because if we're paying less in taxes, then we're going to have more money to spend elsewhere. That also becomes inflationary. You have more dollars chasing the goods and services, it becomes inflationary. And then number 3, lower immigration. And if we have lower immigration, then here within the US, companies are going to have to fill those jobs with employees that they have to pay a higher wage. That could happen, not in all areas necessarily, but that could happen across the US and different industries. That creates wage inflation. Wage inflation trickles through to the end consumer. Ultimately, that creates inflation. Again, that reduces our GDP growth. Now, the one common theme, as you see between these, is inflation. We have all 3 of these policy impacts could create inflation or make inflation stay sticky. And because of that, then we would expect that rates are going to stay higher for longer, which then flows through to all of the other areas of the economy. It's good for some, it's bad for others. Now, it could as well strengthen our dollar and drive up our asset prices. That said, we've seen the dollar strengthen, but we've also seen that we have not had a recession. We were expecting, some expected a recession in 2024. I did not think it would happen in 2024, but some expected a recession in 2024. I thought it might happen in 2025, but the recession risk has actually come down somewhat. We're now at the beginning of 2025 seeing a recession risk of approximately 25%. That's not nothing. And so we have to see if the Fed can continue to navigate everything that is going on and bring us to a point where we have that soft landing, meaning we get a bit of a slowdown, but we don't go into recession. Now, the Fed impacts on all of their policy actions that they're taking always have a time lag, which we know, but we are also seeing, as we look back on what has been unraveling before our eyes, we're seeing in hindsight that it's had a slower impact, much slower than the Fed expected. And one of the reasons it's had a slower, reduced impact is that a lot of consumers, individuals, companies were able to lock in lower fixed rates when rates were low before the Fed began, or at the point the Fed began to talk about increasing rates. So we here in the US had a lot of rates that got locked in. That has helped our economy in some areas, not necessarily the Fed fighting inflation, but it has helped our economy. Whereas in Europe and in Canada, there are rates that are adjustable. They don't have the fixed rates that we do. And so we see their outlook is not as strong as our outlook as a result, partly of the difference in the rate cycle. Now, one of our biggest concerns is, can we have that soft landing? And there are still some risks to that. One would be the Fed policy. Do they make a mistake? And they could reduce rates too fast, too soon, cause inflation to ramp back up, need to increase rates again, put us in this cycle. We could end up with a recession. Another is all of the conflict going on around the globe. We have the China and Taiwan issue. We have Russia and Ukraine, and then we have the Middle East. If any of those ramp up, it could spill over into the US more than it has, much more than it has. And then last of all, we have government debt. And our government debt, as you know, is increasing. It's much higher than it used to be. In fact, it's now nearly $36 trillion. That has doubled since 2019. And our net interest payment on that government debt last year in 2024 was $870 billion. That is more than we paid for defense last year at $822 billion. So for the first time, we're paying more for our interest on our government debt than we are paying on our defense in other areas. The other issue that's going on that I know some of you are aware of because we've talked about it is the buyers currently of government debt has shifted. And we have more individuals that are buying the government debt and more institutions or foundations that are buying government debt. Part of that is because the rate is higher. These are very rate sensitive buyers. And because the rate is higher, they're interested in this rate. But if rates come down, they may not be interested in the rate anymore. We currently, out of that 36 trillion, that Fed balance sheet, we've got 72% of that is in the short-term debt. That is your T-bills and your notes. That debt rolls over very quickly. The T-bills have less than a year or less of maturity. So that is very short-term debt that is rolling over. Now, for the Fed, if that rolls over when rates are lower, that is better for the Fed. All of this puts rate pressure on our government. We need a lower rate to keep the interest expense down. A lower rate is also a boost to our employment because if companies have lower rates, they have a lower cost for whatever their, is tied to interest rates, then they have more money to put towards hiring people, getting people fully employed, and expanding their workforce. A higher rate, however, is needed when we have inflation. And so we've got inflation that came down. It got as high as 9.1%. It's come down. We're not yet to the 2% target, but we're getting closer. But it seems a bit sticky, and it may continue to be sticky for the reasons I talked about earlier. We also have unemployment that is not at a bad rate compared to sometimes in the past, but it is sticky and going up a little bit, or as we have seen in the last part of last year. Those things, are on the Fed's minds. And what should they do? Should they raise rates? Should they reduce rates? Should they hold rates? How soon should they do any of these things? And so that is something that the Fed is going to be paying attention to, and something that we need to pay attention to, because those rates are going to impact which industries are doing better, which industries are doing worse, what is the cost of borrowing, or what interest are we getting paid on things at what level of risk. So we need to pay attention to that. Now, this year, you're going to hear a lot of talk about the stock market being overvalued. I see that on the web. I see that in papers that I read, articles that I read, and I'm sure that you're seeing the same thing. And it's important because price always matters. What you pay for something matters. You want to pay a good price in order to get a fair return on your money. So we talk a lot about the price earnings ratio. That is a ratio that tells you what is the price that you paid for each dollar of earnings in this company or this exchange traded fund or mutual fund, whatever it may be, that you're buying. If you look at last year's earnings per share, you take the price divided by that, earnings per share, you get the price earnings ratio. Or you could look at the forward price earnings ratio, where you're using the next 12 months of earnings. Now, that next 12 months of earnings is an estimate based on consensus, because obviously we don't know what a company will earn in the next 12 months. But that forward-looking price earnings ratio gives a sense of what are you paying today for what we expect the company to earn in the future. The lower the price earnings ratio, the better. You want that to be a lower ratio so that you are paying a lower price. It's just like when you're buying anything, a car, a house, something at the store, you want a lower price. That's a better price. If you're paying a higher price and it's a higher price earnings ratio, then you're paying more for each dollar of earnings. Historically, the price earnings ratio over the last 30 years, JP Morgan put this slide together. Over the last 30 years, the average price earnings ratio using the forward price earnings is almost 17, 16.89. We're right now at roughly 21 and a half, slightly under that. So we are above the average. That means we're paying more than on average we have in the past. When we are below that 16.9, then we are below average. We're paying less than the average. So right now we're above average. We're paying more. That's why people are saying it's expensive. The market is expensive. Stocks are expensive. And there's a lot of talk about, well, what does that mean then? If you're paying more, what does it mean for the next 1 year, 3 years, 5 years, 10 years of returns? And it typically means on average, we're going to have lower returns. If you look historically, then that 21 and a half forward PE puts us on the far right of these two charts. One is a 1 year view and the other is a 5 year view. So we're on the far right as far as the PE ratio. And then that puts us close to the 0% line, above the 0% line, but closer to 0% than 10%, 20%. We're at a low expected 1 year and 5 year return. And again, that's because of the price being paid for the stocks at this point in time. Now, I want to point out that this is an average. It's based on a lot of numbers in history, different times or companies, or, there can be variations within this because this is an average. And so I want to look back to a study that Morgan Housel did. Morgan Housel was a columnist for Motley Fool. He also wrote for Wall Street Journal. He's now retired as a columnist, and he's writing books, and he's doing a podcast. He's doing a lot of great things in the financial industry area. He likes to write about finances and behavioral finance. But Morgan Housel looked back in, roughly 2012. He looked back at the PE ratios in 1995. So before we had the 1999, the dot-com bust, and then the 9/11. So in 1995, what were the PE ratios for each of the 30 companies in the Dow Jones? And what should those PE ratios have been if people wanted to earn an 8% average over the next 17 years? So from 1995 to 2012. The results are very revealing. And it shows you why you can't just use a PE ratio as the rule of thumb and apply it to everything as if it always works. When we look at his study, we see that there were low PE stocks. Some examples are Alcoa and Bank of America and Hewlett Packard. And Alcoa at that time had a PE ratio of 10. Now, that's a very low PE ratio. You would think that with a PE ratio of 10, that is a great price to pay for a stock. But Morgan determined that you should have just paid 2.9 times earnings if you wanted to get an 8% return over the next 17 years. So even with a PE ratio of 10, Alcoa was very overvalued. Their earnings did not hold up over the next 17 years. The growth wasn't there over the next 17 years. And so that price was too high a price for them. On the other hand, there were stocks that had high PEs. Some examples are Chevron, Home Depot, Microsoft. And when we look at Microsoft, for example, one of the names going, right now that I'm talking about relative to AI and the things that they're doing, their purchase of OpenChat GPT, Microsoft at that time had a PE of 28, higher than the average, higher than our current forward PE for the S&P 500, a PE of 28. But Morgan determined that people could have paid 68 times earnings and still received an 8% average return over the next 17 years. So the point is, when you're looking at where you're going to invest, you do want to look at these ratios. And you want to look at more than one ratio. But you also want to consider the company, their growth, their outlook, what industry they're in, the outlook for the industry, all of these other things in order to know, do you believe in this company and in where they could be going? And is it a company or a ETF that you want to hold? Don't just base it on the PE ratio. Investing based on past performance is a lot like just driving, looking in the rearview mirror. It can cause accidents. And so if people had bought Alcoa and sold Microsoft because those were the right PE numbers that they were aiming at, they wouldn't have had the results they wanted. If they had bought Microsoft and sold Alcoa, they would have had the results they wanted. And so you can't just invest based on past averages or past investing data. You've got to put some more, time and effort into that to make the best choices for you and your portfolio. And you need to remember that, just because PEs are high does not mean that there's no possibility for gain over the coming 10 years or 20 years. That's just not true, as we've seen. So where you want to focus right now is, number one, your risk target. How much risk is right for you to take? How much risk are you comfortable with? How much risk do you need to take to meet your plan? And where can you invest to get fairly compensated for the risk that you're taking? You've got to think through making sure that if you're investing and taking risks, that you're getting fairly compensated for that. When you're looking at any type of investment, there's generally three different areas three different factors to that you could receive. One is the growth. Another is the preservation of your capital. And the last is liquidity. You can typically have two of those in one investment, but not all three. Let me give you one example. Some of my clients own real estate. That real estate has good growth over time. It also preserves their capital over time, but it is not liquid. They can't just tomorrow sell it and get a big check. They have to list it. They have to, market it. They have to find the right buyer. They have to go to closing. There's a whole long process before they can get the money for that piece of real estate. It can be short as 30 days, but it could be 6 months, a year, 2 years. It depends on where that real estate is and what the real estate, what's the market for real estate in that area. Another example is high yield savings or money market. That would be an investment that has good preservation of capital and good liquidity. You can access it now, right away, but it doesn't have a lot of growth. And then the last example would be, let's say you've got some stocks or some exchange traded funds. Those would have growth, good growth over the long term, and liquidity, because you can sell that stock or that exchange traded fund today. You can have the cash tomorrow, but it doesn't have preservation of capital at all times. There's going to be volatility in that investment. So as you can see, there are different investments that have different characteristics, and you want to think through the characteristics that you want, that you need, what level of risk are you targeting, and then build your short-term, mid-term, and long-term plan based upon your risk target. Once you know that, you can get the right assets, you can have the right asset allocation, you can have the right asset location, meaning you hold the right investment in the right type of account for your tax efficiency. And that helps you keep more of what you're earning, more of your growth, because you've got it set up in a tax efficient way. So that's what you want to focus on. And you want to start your 2025 tax plan. Are you going to do Roth conversions this year? Are you going to do any tax loss harvesting or tax gain harvesting? What other actions do you need to take? What is the tax impact of that? You need to think that through so that you can put together a good tax plan for 2025. And that will help you set yourself up for a really good year You're going to know at the beginning of the year where you want to take risk, how much risk you want to take, and what actions you need to do to have the best tax plan. And when you get to the end of the year, you should have a good year. Now, I think that the market's going to be up this year. That's what I'm thinking right now. I think it will be more volatile than it was last year, but I'm thinking we're going to still have another year where the market is up overall. And so that's, I hope, going to play into giving you a really good year in all areas that you decide to invest in so that your retirement portfolio is on the best path for you. So with that, I wish you a very, very prosperous 2025.